So it all kicks off with this, honestly, this incredibly simple idea. Every single market only does four things. That's it. Just four. I know, it sounds way too simple to be true, but trust me, this is the bedrock for everything else we're going to talk about. So for now, let's just forget all the noise, forget the fancy indicators, and just lock in on this one single idea.
Okay, so what are these four fundamental moves? Well, we're about to break down the absolute ground level basics. This is what any market, I don't care if it's stocks, crypto, forex, you name it, can physically do. Think of this as like the alphabet of how price moves.
All right, at its core, it really is this simple. Price can go up, it can go down, or it can just kind of pause and move sideways. Take a breather. That's pretty much the entire universe of what can happen. And that fourth thing, well, it's just a combination of these three. But the real magic, the secret sauce, is in how we learn to read these movements.
And this right here is the key that unlocks the whole thing. If you can just get good at one skill, spotting and understanding the peaks and valleys on a chart, the highs and the lows, that's it. That's the single most important part of reading price. If you can master this, you are so far ahead of the game, and you actually start to hear the story the market is trying to tell you.
All right, let's build on that. It's time to learn a little vocabulary. To really read that story, you need to know four essential labels. Think of these as your signposts on the chart.
First up, we've got the higher high, or HH for short. Now, you can think of this as a clear win for the buyers. They didn't just get back to the last peak, they had enough oomph to punch right through it and set a new record. This is a big, flashing sign of strength and upward momentum.
Next is the higher low, or HL. Okay, so this one isn't about setting new records. This is all about playing defense. Imagine the price pulls back, but the buyers jump in before it can drop to the previous bottom. They're basically drawing a line in the sand saying, nope, not going any lower. It shows they're still in the game and propping up the price.
Now for the flip side, we have the lower high, or LH. This is a sign that things might be getting a little weak. The buyers tried to rally, they tried to push the price back up, but they ran out of steam before they could even get to the last peak. The sellers showed up early, put up a wall, and said, no thanks. This is a huge clue that the momentum might be shifting. And last but not least, the lower low, or LL. Now this is the knockout punch from the sellers. They didn't just defend their turf. They had enough power to smash the price right through the previous bottom. When you see this, it's a clear signal that the sellers are now firmly in the driver's seat. Okay, let's just recap that real quick. Higher high means buyers are pushing. Higher low means buyers are holding the line. Lower high means sellers are pushing back. And a lower low means sellers are totally in control. That's it. Those four labels tell you the entire story of what's happening on the chart.
So, we've got the words. Now it's time to put them together and form a sentence. We're going to see how to combine these labels to spot a really clear story of buyers taking control, which, of course, is a potential buy signal. Now, this story has to happen in a very specific order. It's a two-step dance. Step one, the buyers have to play defense and hold a higher low. They have to prove they can hold their ground. Then, and only then, do they switch to offense and break through to make a higher high. That order is absolutely crucial.
And here's the rule, boiled down to its simplest form. When you see a higher low, followed by a higher high, that's the market screaming at you that buyers are in control. That's the textbook definition of a bullish trend structure, and it's our green light for a potential buy.
Okay, so spotting the setup is great, but that's only half the battle, right? Knowing exactly when to pull the trigger, and maybe even more importantly, when to just sit on your hands and do nothing, that's the next critical piece of the puzzle. So let's look at how this structure actually guides our decisions. And this really is the million-dollar question, isn't it? Okay, we see the pattern, we know the buyers are in charge, but where in the world is the best spot to actually buy? Where can we get in without feeling like we're just chasing the price at the very top? Well, here's the answer. The sweet spot, the ideal entry, is not at the top of that new higher high. That's just chasing. The smarter, more strategic entry is after that higher low has been confirmed. We want to get in right at the spot where the buyers just prove to everyone that they're willing to step in and defend that price. So it all comes down to knowing the difference between a green light and a yellow light. If you get that higher low followed by a higher high, that's your green light. The buy is on. But what if price makes a lower high and then just starts moving sideways in a choppy mess? That's a yellow light. The story is unclear. And you know what the best trade is then?
doing absolutely nothing. Patience is a trade.
And just like this structure gives us a clear signal to get in, it gives us an equally clear, totally mechanical signal for when to get out. See, as long as the price keeps making those higher lows, our bullish story is still playing out. But the instant a higher low gets broken, the story has changed. The trade is done. It's really that simple. No emotions, just a rule.
All right, we've covered a lot. We've got the labels, the buy signal, and the rules for getting in and getting out. Now let's put it all together. We're going to train your eye to see this stuff instantly. Think of this as your new 1-second chart reading test.
From this point forward, every time you look at a chart, I want you to ask yourself one simple question. Just ignore everything else for a second and ask, are the highs and lows, the peaks and valleys, are they basically going up or are they basically going down? And here's your cheat sheet, your quick answer key. If the answer is up, then the market is bullish. If the answer is down, it's bearish. And if you look at it and you can't tell right away, if it's just a messy, sideways grind, then the answer is unclear. And what do we do when it's unclear? We wait.
And there it is. That's the whole system in a nutshell. Higher highs and higher lows, that's the buyers showing their strength, giving you a buy signal. Lower highs and lower lows, that's the sellers. The HL followed by HH sequence tells you when to go, and the break of that HL tells you when it's time to get out.
Let's wrap this up with a really important piece of wisdom. What we've been talking about, it's not about being a fortune teller. It's not about predicting the future. It's about having a game plan and then having the patience to wait for the market to give you a setup that fits your plan. This is a game of observation, not prediction. Because at the end of the day, the price itself is always telling you a story. Every single minute, it's showing you where buyers are strong and where sellers are taking over. Your job isn't to fight the market or to force it to do what you want. It's just to learn its language, to listen to what it's saying, and then act accordingly.